Welcome back to Charged Alpha. I'm Hudson Thomas, joined as always by my co-host Lana Chen. In this segment, we're zooming out from the quarterly noise for a full company chapter.
That's right, Hudson. Before we dig into the latest earnings, let's make sure we actually understand this business, what it does, how it makes money, and what makes it competitively distinct.
Allegion was born as Schlage Lock, founded in San Francisco in 1908 by Walter Schlage. After decades inside Ingersoll Rand, it was spun off as an independent public company in 2013.
Allegion makes door hardware and access control systems, physical and electronic security products that control who can enter and exit buildings. Every hospital, university, government building, and hotel is a potential customer.
The Schlage brand is the residential and commercial anchor, installed in tens of millions of U.S. homes, and the default specification choice for builders and contractors nationwide who want a trusted, recognizable lock.
In institutional settings, hospitals, schools, airports, security consultants and architects specify products by brand and model before construction begins. Getting specified means getting sold. That specification moat protects Allegion's market position.
The Americas segment generates approximately 76% of revenue. The U.S. commercial and institutional market is the profit engine. Longer sales cycles, larger orders, and higher margins than the residential replacement channel.
The international segment covers Europe, Asia-Pacific, and Latin America through CISA in Italy and Interflex in Germany. These businesses serve commercial and transit customers where electronic access control adoption is accelerating.
Electronic access control is the secular growth story. Replacing mechanical locks with connected smart locks and card reader systems generates hardware revenue plus ongoing service fees, a recurring model layered onto the traditional hardware sale.
Electronics represent about 35% of Allegion's product mix and grow every year. That shift improves revenue per door and expands the addressable market by adding connectivity, data, and integration opportunities beyond the physical hardware.
On the competitive landscape, Allegion competes against ALLE, the Swedish global leader, and Carrier Global Security Division. ALLE has greater global scale. Allegion's advantage is deeper U.S. institutional relationships.
John Stone became CEO in 2020 and has focused on accelerating the electronic transition through organic product development and targeted acquisitions of smart lock and access control technology companies.
Operating margins around 22% reflect branded hardware pricing power and the institutional specification business, where customers pay a premium for reliability and code compliance over commodity alternatives.
Allegion has raised its dividend for 10 consecutive years since the 2013 spin-off. The yield is modest, but dividend growth has been consistent and supported by strong free cash flow generation from the business.
Products installed in buildings across over 130 countries underscore global demand for institutional security hardware. Every new building constructed and every renovation creates an opportunity to win door-by-door specification battles.
The long-term secular driver is building security investment. Institutional customers allocate more capital to access control, electronic monitoring, credential management, and audit trails, all requiring Allegion-type solutions.
That's the company chapter for Allegion. Now that we've got the full picture, let's get into the earnings.
Time to dig into the numbers. Let's go.
Welcome to Charged Alpha, the show that goes deep on the company's moving markets. I'm Hudson, and today we're locking in on Allegion, ticker ALLE, the security hardware specialist that spun out of Ingersoll Rand back in 2013. Market cap sitting around $11.6 billion. Allegion reported Q1 2026 results, and the headline is a miss. EPS came in at $1.80 against an estimate of $1.88, a 4.3% shortfall. Revenue landed at $1.026 billion. So we've got a company with a dominant market position in security hardware, riding the long-term wave of electronic access control, but stumbling slightly on the bottom line. The question investors are wrestling with is whether this miss signals something structural or just short-term noise in a business that's been quietly compounding for over a decade. Lana, set the stage for us.
Happy to, Hudson. Allegion is not a name that gets a lot of headlines, but it should be on every investor's radar. The company makes security products. We're talking locks, door hardware, access control systems, and everything in between. Their brand portfolio is exceptional. Schlage is the #1 residential lock brand in the United States. Von Duprin dominates commercial panic hardware. LCN makes the commercial door closers you interact with every single day without thinking about it. And Interflex handles electronic access management for large facilities. This is a company that sits at the intersection of physical security and digital connectivity, two trends that are only accelerating. The Americas commercial segment, which serves hospitals, schools, universities, and office buildings, is their biggest revenue driver. The electronic access control piece is growing north of 10% annually as institutions move away from mechanical keys towards smart card readers and mobile credentials. That secular shift is Allegion's long-term tailwind.
Let's get into the Q1 numbers. Revenue of $1.026 billion, that's the top line. EPS of 180 versus the 188 estimate. Now a 4.3% miss on earnings per share is notable, and the market clearly noticed. The question is what drove it? In a quarter like this, you want to understand whether the shortfall was volume-driven, meaning fewer units shipped, or margin-driven, which would point to cost pressure or pricing headwinds. Allegion's business is skewed toward institutional and commercial end markets, and those segments have been feeling the pinch of a non-residential construction slowdown. When building starts slow down, door hardware demand follows with a lag. The Americas commercial segment is the core of the business, and if institutional project pipelines are thinning out, that shows up in shipped units. The residential side, anchored by Schlage, faces its own headwind from the broader housing market slowdown, where elevated mortgage rates have suppressed both new construction and renovation activity.
The income statement context matters here. Allegion has historically been a very well-run business from a margin perspective. Gross margins have consistently held in the mid to high 40s, and operating leverage has been a key part of the investment thesis. When volume softens, that leverage works in reverse. Fixed costs spread over fewer units compresses margins. The EPS miss at 4.3% likely reflects some combination of volume softness and the operating leverage dynamic, rather than any fundamental deterioration in pricing power. Allegion's brands carry real pricing authority, particularly in commercial. Schlage is a premium product in residential and commands a meaningful price premium over generic competitors. The question analysts are probing is whether the Q1 softness is a one-quarter blip tied to project timing or the beginning of a more sustained correction in non-residential demand. Management's guidance commentary on backlog and order trends in commercial will be the key signal to watch from the earnings call.
The moat story at Allegion is one of the most straightforward in industrials. Think about how this business works. Allegion products are specified into buildings at the design phase by architects and engineers. Once a lock standard or access control platform is written into a building specification, it's extremely difficult to displace. This specification process creates a durable installed base that generates recurring aftermarket revenue, replacement parts, service contracts, upgrades. In commercial, building owners who installed Schlage or Von Duprin hardware 20 years ago are the most likely customers to upgrade to Allegion's electronic access products today. That brand continuity creates a pull-through effect that competitors cannot easily replicate. The switching cost story is particularly powerful on the electronic side. Once a facility deploys an access control platform, say a hospital using Interflex for credential management, ripping that out and replacing it is enormously disruptive. That's multi-year revenue visibility built right into the product architecture.
Cash flow is where Allegion really shines as a business. This is a capital-light manufacturer with very consistent free cash flow generation. The business doesn't require heavy reinvestment to maintain its competitive position. The moat is built on brand, specification relationships, and product standards rather than massive physical plant. That capital efficiency translates into a business that converts a high percentage of net income into free cash flow, which in turn funds consistent capital return to shareholders. The dividend yield is approximately 1.2%, modest but growing. The buyback program has been steady and meaningful. Allegion has consistently reduced its share count over time, which is a meaningful contributor to EPS growth independent of revenue growth. For investors evaluating the total shareholder return picture, the combination of dividends, buybacks, and earnings growth has historically produced solid mid-single-digit to low double-digit annual returns. The question is whether the current valuation properly prices that return profile.
Capital returns and capital allocation. This is a company that has been very deliberate about how it deploys cash. The buyback program has been consistent. Management has expressed a preference for organic investment in electronic access and connected products, supplemented by bolt-on acquisitions in adjacent security markets. The balance sheet is managed conservatively, with leverage in the comfortable range for an investment-grade industrial. The dividend has been raised consistently since the spin-off, reflecting management's confidence in the earnings power of the business through the cycle. One thing worth noting is that Allegion has historically avoided large transformative acquisitions. They've been disciplined, buying smaller companies that fill product or geographic gaps rather than swinging for conglomerate-style deals. That discipline has kept the balance sheet clean and avoided integration risk. In the current environment, with rates elevated, that conservatism looks even more prescient.
The catalyst landscape for Allegion is actually quite interesting, despite the earnings miss. The single biggest catalyst is the continued shift from mechanical to electronic access control. This is a multi-decade secular trend. Just look at the penetration rates. The majority of commercial doors in the United States still use mechanical locks. As those systems age out and get replaced, electronic access is the default upgrade path. Allegion's Schlage brand is positioned to capture residential smart lock demand through integrations with Apple HomeKit and Google Home. The commercial electronic access platform driven by Interflex and next-generation readers targets the institutional market. Second catalyst, America's institutional construction. When the backlog of deferred school, hospital, and government building projects works through the system, Allegion gets a disproportionate share of the hardware specification. Healthcare facilities in particular are a high-value vertical given the stringent access control requirements. Third catalyst, international expansion in Europe and the Asia-Pacific, where Allegion is underpenetrated relative to its Americas dominance.
The analyst community is sitting at a consensus hold on ALLE, with a price target around 140 against the current price of roughly 130. That's a modest upside, call it 8 to 10%, which is not exactly screaming cheap. The hold consensus reflects genuine uncertainty about the near-term earnings trajectory given non-residential construction headwinds and the Q1 miss. The bull case from analysts who are more constructive centers on the electronic access growth opportunity and the argument that the current weakness is cyclical rather than structural. More cautious analysts point to the valuation. At 20-plus times forward earnings, Allegion is not cheap for a business growing earnings in the mid-single-digit range organically. The premium valuation has historically been justified by the quality of the business. High returns on invested capital, strong free cash flow, durable competitive position. But in a risk-off environment where investors are scrutinizing quality premiums, that multiple is a vulnerability.
Valuation is the central debate on Allegion. The stock at approximately 20-plus times forward earnings is pricing in a relatively optimistic view of the earnings recovery and the electronic access growth ramp. For context, high-quality industrial peers with similar growth profiles often trade in the 16 to 20 times range. The premium Allegion commands is a function of the brand strength, the recurring aftermarket revenue, and the specification-driven moat. But here's the math challenge. If earnings are tracking below estimates and the non-residential cycle is softening, a 20-plus multiple on declining estimates is a double compression risk. The multiple could contract at the same time the E in the PE equation is moving lower. That's the scenario that makes cautious investors nervous. On the other hand, if Q1 proves to be the trough and commercial construction re-accelerates in the second half of the year, the stock could re-rate quickly. The valuation is not egregious for what you own, it's just not forgiving to negative earnings surprises.
Bull case 1, the electronic access control inflection. This is the most powerful long-term argument for Allegion. The conversion from mechanical to electronic locks in commercial settings is still early innings. Consider that the installed base of commercial doors in the United States numbers in the hundreds of millions, and electronic penetration remains a minority of that base. As facilities upgrade, as building codes evolve to require electronic access for certain facility types, and as the total cost of ownership of electronic systems drops with scale, the conversion accelerates. Allegion's brands are the default specification for architects and engineers in the United States. That specification relationship means they capture a disproportionate share of the upgrade cycle. Electronic products carry higher margins than mechanical. They require more software, more integration, and more ongoing service. As the mix shifts toward electronic, Allegion's margin profile improves structurally. This is a business where the product mix itself is a margin tailwind for the next decade.
Bull case 2, institutional construction recovery. The non-residential construction cycle is notoriously lumpy, but the underlying demand drivers for institutional construction remain intact. Hospitals are aging and need replacement. Schools are undermaintained and facing enrollment growth in many markets. Universities are expanding STEM facilities. Government buildings require security upgrades as access control standards tighten. These projects don't disappear. They get deferred. And when the interest rate environment improves and municipal financing costs come down, the pipeline of deferred projects starts moving again. Allegion is one of the purest ways to express a view on institutional construction recovery in the public market because of how dominant their position is in the hardware specification process. When a hospital project breaks ground, Allegion wins the door hardware specification in most cases. That leverage to institutional construction recovery is not fully priced into the stock at current levels, particularly if you believe rate relief in the second half of the year catalyzes project starts.
Bull case 3, Schlage residential brand and the smart home opportunity. This one is easy to overlook because it's not the biggest revenue driver, but the strategic positioning is compelling. Schlage is the #1 residential lock brand in the United States by market share. That brand equity is enormous. As consumers upgrade to smart home ecosystems, Apple HomeKit, Google Home, Amazon Alexa, the connected lock is one of the first smart home devices they purchase because of the direct security benefit. Schlage has deep integrations with all 3 major platforms. The smart lock market is growing rapidly, and Schlage is positioned at the premium end of that market. The average selling price of a smart lock is significantly higher than a mechanical deadbolt, better revenue per door opened, if you'll pardon the pun. And smart lock users are more likely to be repeat purchasers and brand loyalists. This residential connected home exposure gives Allegion a consumer brand dimension that most of its commercial hardware peers lack entirely.
Bear case 1, non-residential construction slowdown with no clear bottom. This is the most immediate risk for Allegion. Non-residential construction activity has been softening, and the leading indicators, architecture billings, commercial permit data, are not pointing to an imminent recovery. If institutional construction activity remains subdued through 2026, Allegion's Americas commercial segment, which is the highest margin part of the business, will continue to face volume headwinds. The Q1 miss may be the first data point in a trend rather than an isolated event. The compounding problem is valuation. If earnings estimates need to come down further and the multiple remains elevated, the stock faces pressure from both directions simultaneously. Competition on the electronic side from ALLE and Dormakaba, both of which are large, well-resourced European competitors with global specification relationships, adds another layer of risk. Allegion's America's dominance is a real advantage, but international competitors are increasingly sophisticated in the U.S. market.
Bear case 2, premium valuation at risk in a single-digit growth environment. Allegion's business generates organic growth in the mid-single-digit range through the cycle, punctuated by electronic access acceleration. That is a solid but not spectacular growth profile. When the market was pricing in higher growth expectations, 20-plus times earnings was defensible. But if the organic growth rate settles at 4 to 6% and earnings estimates face downward pressure from a weaker non-residential cycle, the multiple needs to compress toward fair value for that growth rate. Call it 16 to 18 times. The math on that compression is painful. From 130 at 20 times, a move to 17 times on slightly lower earnings could put the stock in the 110 to 115 range, a meaningful drawdown from current levels. That is the scenario that bears are modeling. The business is high quality and will survive. No one is making a bankruptcy argument, but quality businesses at full valuations can be poor investments for multi-year periods when growth disappoints relative to what the multiple implies.
Bottom line on Allegion, this is a high-quality business with a genuinely durable competitive position, but the Q1 earnings miss and the non-residential construction headwinds create real near-term uncertainty for a stock trading at a premium multiple. The electronic access secular trend is intact and compelling. The Schlage residential brand and smart home positioning are underappreciated. The free cash flow engine is consistent. But at 20-plus times earnings, the stock is not priced for a volume air pocket. And that's exactly what the Q1 result suggests may be emerging. Analysts are sitting at a hold with a 140 price target, modest upside, balanced risk profile. For long-term investors who believe in the electronic access conversion story and can tolerate the cycle volatility, accumulating on weakness toward the low 120s makes sense. For the shorter-term oriented, the safer posture is waiting for evidence that commercial order trends are stabilizing before adding exposure. Financial data sourced from Financial Modeling Prep. Charged Alpha is for educational purposes only and does not constitute investment advice. Always consult a qualified financial advisor before making investment decisions.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.